Since Bart is traveling, he asked me to chair today's meeting. So we'll do a call to order, roll call. Just read through. Bart Hillier, absent. Michael Capato is absent. George Losleben is not present. Steve Waham.
Present.
All right, thanks, Steve.
What a deal.
English
I'm
is
number one.
Scott Summers is traveling at a conference. He's absent. Dave Dixon, I'm here. Howie Murray, here. So, okay. We can't approve the minutes approve or amend the agenda. I guess we can do that because we don't have, doesn't matter whether we have a quorum or not. Steve, you want to make a motion to approve the agenda?
Yes, I hereby move to have the agenda approved.
And I'll second it. So we're all in favor? You and I? Aye. Okay. All right, great. And then the prior minutes, we're not going to be able to vote on those since we don't have a quorum. So going to the chair comments. Today we're going to start with Kevin. And then we'll go with Brendan. I'll probably keep, as far as the agenda goes, I'll probably keep Brendan and John on both, depending on who's going to speak. That way they can interchange between the two of them. Then on the investment committee educational materials, I was just going to review the CPM, the IPS for us. But really with everybody being veterans, there's not much addition there. And then the staff report was going to be a recommendation regarding our short-term cash needs. So I am going to turn this over to Kevin.
Sounds good. So again, Kevin Polewski, I'm with the JP Morgan Private Bank. I know I haven't met some of you, and apologize again for the not attending the last meeting as I had some family emergencies back east. So wanted to first say obviously the markets have been all over the place recently. Equity markets have done well year to date. Obviously, there's been some rotation amongst the leaders in regards to the Mag 7, to chips and semis, to financials, which has kind of changed the investment landscape in regards to probably your accounts with Brendan and John more so than with what we're doing here. The accounts that we've got with you guys are strictly a cash account that's in a money market account, as well as a short-term cash account that's invested in dividend-paying stocks, as well as a global bond portfolio that's there. The positions that are held within these accounts, again, there's a couple of positions, and I'll bring up my, I'm going to share my screen with you guys.
Okay.
You able to see that? Bigger, smaller?
There we go.
You need it bigger, smaller? Good.
That looks good on my end.
All right. So again, we've got two accounts. They both say brokerage account. They are not managed accounts. They're individual positions that we hold in the accounts. The larger account is the cash account, which has decreased a little bit recently, as we had a draw of about 650,000 from that account. And the other account is, I would say, longer term invested and there for any emergency cash needs, should there be any. In regards to the allocations on these accounts, again, the larger account is all in a money market fund. It's paying about 3.43% today. Obviously, that fluctuates on an ongoing basis, but is higher than kind of your standard money markets that the bank offers that are out there. And, it keeps it liquid for you guys to be able to add to it and also take out for funds for the checking account that we transfer to the Chase account. In regards to the longer term equity holdings, we've got two positions, the Vanguard growth ETF, as well as the Schwab dividend ETF on the equity side, which traditionally we have split 35% each. And we've had a little bit of drift on that because of the equity markets performing so well versus the fixed income markets that have kind of just, I would say, been relatively flat to slightly down on what we would expect over the year. The global fixed income is at least 50% US bonds and then also international bonds as well. All the positions are up for the year, but we've got about a 30-70 split between the accounts as it sits today. Performance-wise, so overall, between the two accounts, we're up 5% year to date. 4.5% if we're going through quarter end 6/30. If we're going through year to date through, I believe it is July 6th, when we put this report together, you're up another 0.5% there. Again, the difference between the two accounts is significant. Obviously, one is just cash, earning us again on average about 3.4 to 3.5% on an annual basis. So we're up 1.7 year to date through the end of the quarter. And then for the longer term equities, you're up 9.7% for the second quarter through second quarter, and up 10.7%, so up another percent in just the first week of the third quarter. So overall, again, 10.7, 9.7, 1.7, in line with what the benchmarks are for what we're investing in. These positions, which are on the next page, again, the Schwab dividend ETF is up significantly, 17.5%. It does invest in financials, energy, staples, which have all done very well this year. Whereas the Vanguard dividend appreciation ETF, it would be more in information technology, but in some of those that do not pay dividend, in the ones that do pay dividends, not the high flying ones that maybe you've seen recently that are up, 300-400% in the last, couple of weeks or months. So there's the difference between the two in terms of the return. If you see here, the 17.5% for the Schwab dividend ETF and the Vanguard at 8.5%. Over the course of time, they are pretty closer together. I would say they're within about 2 percentage points in regards to the overall return over the 5 and 10 year periods. But with the changing of, I wouldn't say the changing of the guard, but the change in leaders so far this year has caused the difference in regards to the returns between the two, and why we have both of them, because they complement each other. In regards to the global bond fund, year to date up 1.9%. A lot of that is due to inflation that kind of has been sticking around for a little while. Obviously, since the beginning of the year, interest rates from a 1 to a 10-year treasury have gone up about 50 basis points, and when yields go up, usually principal goes down a little bit. But overall, we're up 1.9 through second quarter, which is slightly less than what we would expect coming in at the end of the year in regards to somewhere around a 5 to 6% return all in on that. So depending on what happens with inflation, with disruptions in the Middle East, could fluctuate kind of the bond market and actually the equity markets as well going forward. So as of right now, the latest print on the inflation front seemed to be pretty tame, which the Fed had anticipated potentially having to raise rates towards the end of the year and maybe into next year. Whereas at the beginning of the year, we were thinking interest rates were going to go down, to now, stay the course and potentially, cuts back on the table. Especially with the new Fed, that's kind of what seems like they would like to do longer term is to lower interest rates. But again, I think a lot depends on geopolitical issues as of right now. Any questions on anything that kind of I've talked about at this point?
Sure.
That's a
Yeah,
lot.
that's a question.
Hi, Kevin. Hi, Kevin. This is Carol Crothers. I've been in many of these meetings and,
Yes, how you doing, Carol?
okay. One of my questions is, since we have a substantial amount of money in these accounts compared to an ordinary investor, do you invest in the accounts that require a minimum of 100,000? They usually pay a little bit more than just the ordinary account. I just looked up Schwab, for example, and the account that pays, this is short term, you can get your money out in a day, pays 0.15% more than the just everyday account for investors like me.
Gotcha. So with these accounts, anything there's different. You're talking about the different share classes in the money markets, I'm assuming.
Yes. If you have over 100,000, you almost always get a better rate. And sometimes it's, as much as 0.25%, which is substantial.
No, absolutely understand. So the share class that we're in with this money market is called the Premier Money Market class, which for private bank clients is kind of the base level in regards to it's above kind of what you can get in the Chase branches and Chase Private Client, but kind of the level in which we start at in the money market funds. Once you get up to 5 million, there's an agency share class, and then there's an institutional share class at 10, and then a capital share class at like 25 million. And each of those bump up a little bit. And depending on, when you're getting that rate, because sometimes they'll post rates from like the end of the quarter, which could be higher, like could be 0.15 higher than where, our daily rate is stated, right? So if I went back in, you want to make sure that you're using that same rate. Sometimes they use a 7-day average or a 30-day average, or there's a daily rate. So depending on the fund and what quote you're getting, it could be a little bit different. And depending on what is actually held in there, could also be slightly different.
Okay, well, I'm just, and sounds like Morgan doesn't give as good a rates as Schwab does, but you get into a Schwab account. And just to give you an example today, and I understand what you're saying, how it could be a little difference if it's 7 days versus overnight rates, but the Schwab Prime Advantage Money Fund, SWVXX, right now pays 3.45%. The Schwab Prime Advantage Money Fund, Ultra Shares, and you have to have a minimum of $100,000. So, I can't invest in that, but you could, is 3.6%. Both of these sound like they're higher than what you're able to get for us out of JP Morgan, even though we have a substantial amount of money, $4 million.
Let me see. Again, the rates that are stated, we don't have any control over what we can offer in terms of those stated rates. It's a money market or a CD on the bank side where we've got some negotiation abilities. But let me see if I can bring it up real quick for you, because I do have it on a different screen, and I can kind of go through it with you. So this is the money market fund that we're talking about. The daily rate as of July 13th was 3.43. If we go down here, so the 7-day is 3.49, right? So it is a little bit higher as of the 7-day rate. So obviously in the last couple of days, the yield has come down a little bit, and that's going to fluctuate over time. Is it 3.6? No, it's not. It's not 3.6. And the minimum investment in this is $1 million, but it's waived for private bank clients. And then if we go kind of up here, let me scroll back up, because we have different share classes. The next share class would be the agency share class, which if we had 5 million in this fund, it would be 3.59. So again, and that's as of today's rate, and 3.65 would be the 7-day SEC yield.
Yeah, I see. And so it's a 0.15 differential, basically. So that seems to be the going rate. I'm just curious, when you're dealing in millions of dollars, you ought to be able to get a little bit better rate. And certainly a retail brokerage like Schwab will give you a better rate if you put in 100,000 as opposed to $1 million. That's my only point. So if you can't, and you're investing in some other Schwab accounts, not move the money to Schwab.
So money markets are proprietary to the actual company that they're held with. And so even if you had an account at Schwab and you wanted to transfer this JP Morgan money market to Schwab or vice versa, they would have to liquidate it and send the cash because they're proprietary. And so money markets don't transfer between organizations due to the short-term nature of the underlying investment and the liquidity that's involved in it.
Okay, thank you.
Any other questions?
I don't have any for you. Kevin, Steve, do you have any?
Well, actually, I do.
Okay.
I have a number of these funds, and I'm just wondering why we don't use them. I'm sure there's a reason, but JP Morgan has got some really outstanding rates of return on pretty stable funds. Among the best would be JEPQ, and that's about 11% yield. JEPI, and that's about an 8% yield. And I could go on. There's more. JP Morgan has got a very, very broad portfolio of funds like this. And so I would just say, why don't we do a little better than we're doing? Because, it's there.
Yeah. So when it comes down to that brokerage account, right, with the investments of the Vanguard and the Schwab and the Global Bond, it's a brokerage account. And so it has to be directed from the investment committee, right, in regards to what we're doing. So we're not actively managing this account that maybe like Brendan is doing on some of the accounts there. So it's more of a conversation and maybe a change in your policy that we would be able to invest in some of these things. So can we do it? Absolutely. It would have to be kind of discussed and agreed upon in terms of doing some of those investments within that brokerage account as opposed to what we're doing. And again, what we've been doing has been doing well and working, right? And the yield on them is 11% or 8%, right? But it doesn't necessarily mean the total return on them is going to be 11, 8%.
Well, actually, the last year, the one I just mentioned, the annual return is almost 19%.
And if you go back to what even the Vanguard, if we go back, let me see if I can share that as well. So I want to make sure that we. So the Vanguard position, if you go back 1 year, it's up 17.5%. And on average, over the last 3 years, it's up 15.39. And again, I'm not opposed to it. It's a JP Morgan product, right? It's just, it's focused on, and it is a derivative product. It's not necessarily a straight equity product. And so that they generate income by using derivatives to add to the income that's there. And so you are taking some additional risk with that, right? As opposed to just straight equities per se.
Yes.
In funds. So just as kind of it's definitely a step up in terms of nuances and how people invest today, but it is more, I would say, it is more of an income play per se than it is as a straight equity, maybe growth play per se.
You're right. It's income. So if we take JEPQ, for example, it's running about 11% yield using a covered call strategy, which is relatively low risk, in my opinion. I don't know. I'm just throwing it out there. If y'all want to
Yeah.
try to do something with that, that'd be a nice thing for the benefit of GVR's membership.
I mean, I can send information to Dave and have it disseminated to everybody to take a look at. The JEP-E and the JEP-Q, and there's a couple of other ones as well that I would say that they're more recent to the market. I know JEP-E and JEP-Q have kind of been the longer standing ones. There are some other ones that have also come to market as more recent, and the theme, it feels like, within the industry in general is that a lot of these mutual funds are moving into more ETF driven investments as well, like you stated.
Well, I think that'd be a good idea. Why don't you put some of those, put together a list of suggestions and send them on
Yes.
in.
Yeah, absolutely will.
Thank you. I don't have anything better today than that.
All right, thanks, Steve.
Sure.
And then, I mean, again, our outlook for the end of the year is that interest rates are gonna stay the same. So you won't see probably too much fluctuation on I want to say on the bond side of things, other than the income coming off of the bonds, unless we see again another spike in interest rates, which could happen with what's going on in the strait. And then on the equity side, you know, corporate earnings look pretty good. There's a lot of CapEx spending in the AI space. As long as the earnings outlook looks good for that space, I think the economy will continue to click along. Consumer sentiment is okay. Not seeing significant declines. I think obviously the unemployment rates has kind of stayed the same, but some people dropping out of the labor force. But overall, we see the economy on stable footing. We're not really worried about any kind of recessionary worries at this point in time. And looking forward to a good second half, maybe not as good as the first half, but maybe a good second half with a little bit of volatility in there, depending on, again, I think more the geopolitical issues that are out there than anything else.
Okay. All right. Well, I think that is pretty much all of your stuff, isn't it, Kevin?
Yeah.
All right.
Thank you.
Okay. Certainly. And Brendan, you wanna queue up your stuff or?
Yep.
All right. Fantastic.
I'll share my screen here.
Yeah. I don't mind. Yeah.
Let me know if you can see this okay.
Yes.
Awesome. So yeah, as I mentioned earlier, John's getting foot surgery today, so just rolling solo today. But yeah, thanks for the time as always. Kind of getting into the accounts here again before we kind of start. I just want to give a quick overview, and then again, as we typically do this, the first half will just be kind of going through the accounts, looking at allocations and things of that nature, and then the second half we'll get into more kind of macroeconomic themes and stuff that things that are out there, stuff clients are bringing up, and kind of addressing some of the headlines. But yeah, I think Kevin kind of touched on this, but just to kind of give our spiel, I think this year's definitely been more resilient than most people expected. Looking at just kind of economic growth. And the labor market, economy is still growing at a nice steady clip. Unemployment's remained, low last few months at 4.3%. So we're not seeing any signs of major stress there. We're kind of in this no hire, no fire zone right now. People that are having a hard time finding jobs are more so new graduates, not necessarily more experienced people in the workforce. I think, in our opinion, right now, the biggest issue is inflation, and just obviously what happened with Iran and oil prices, as that, kind of remains elevated, again, that all factors in interest rates and what expectations are there. But, we have the viewpoint that rates are going to be higher for longer. And again, we went from pricing in a few hikes, or I'm sorry, a few cuts to now potentially 1 to 2 hikes. So that's a moving target, but we'll see how that develops. But again, oil prices are they're a big factor, right? They're very inflationary, just with obviously people think about gasoline, cars, and whatnot, but it's an input in many things we do. So it has a big impact on cost of goods and the like. So something that we're definitely keeping our eye on. But I mean, markets have had, again, as Kevin kind of mentioned, it's been a strong year. We've seen earnings growth, well exceed expectations, right? Q1 earnings growth was 28%, right? That blew expectations out of the water. So I think, if we can continue to see that growth, obviously that's a head, that's going to be a tailwind for the market, right? I always mention, at the end of the day, markets care about earnings and growth in those earnings, right? At the end of the day, there's a lot of noise going on, but if companies are making money and they're growing that at a high pace, the markets are going to continue to do well, right? And we've seen that momentum continue from last year into this year. So that's been a positive, but I think when you look at under the hood, we just still have a high level of concentration in the index, right? So again, when you look at kind of that Mag 7, which is, really related to this tech AI kind of, boom, it's about 35% of the index. And so, in our opinion, again, we like to bring that up because, if you just had a market weighting towards the index, you're kind of taking more of a bet, in our opinion, versus, on a handful of companies with, I think there's still a bit of uncertainty, quite a bit of uncertainty around how this AI is going to play out. Obviously, it'll have a great impact, but to what extent and how long, I think, are the big questions. Although, as I'll show you later, we have some key points on CapEx and adoption that we are kind of seeing, which is good news, but there's just still record amounts of CapEx, coming in. So I always like to say, we're equally as focused on controlling risk as we are return. We don't want to chase return. We always want to make sure we're well diversified. And along that same theme, right? We have been diversifying more into the international markets, and smaller mid-sized companies, really on the basis around, valuation. They're just much more attractive, right? They're earning a lot more and they're a lot cheaper to buy, pretty much. And so that's been that's starting to do well. We're starting to see a little bit more of a broadening out so far this year. And again, we think on the international side, there's a lot of tailwinds, given the more favorable government policies, increased spending, especially in the Eurozone, fiscal spending, and weakening dollar. I think the dollar is somewhat of that's gotten more concerned recently, just with the fiscal deficits. But that's been an area we do like. Again, we still have a large portion in U.S., but it's been a good diversifier, and we've been kind of piecing that in over the last year or so. Again, I think all this being said, we kind of are entering a phase here where I think we're going to be in an environment where there's higher rates for longer. We have a lot of uncertainty right now with how this thing in Iran will play out, in the peace deal, and what impacts oil prices and those things. And then obviously there's also, midterm elections that'll be happening, not too long from now. So I think there's a lot of volatility out there, but I think right now things are working in our favor. We do have a strong economic backdrop right now. Again, unemployment's has remained low. The economy's growing at a good steady clip still. But I think just a lot of eyes around inflation and how that could impact things. On the bond side, again, there was a big kind of spike in yields that occurred, earlier this year when oil prices increased. But the thing with bonds is, and as you'll see as we go through the accounts, I more so just want to kind of talk about broad picture stuff as it helps kind of with going through the numbers here in a second. But with the bond side, there was a bit of short-term pain when yields shot up, when oil prices did. However, the ag is up this year. And people say, well, there's a massive move in the 10-year, and which caused a lot of pain. But because bonds have such a starter high in yield than they have in years past, it's already made up for that return, right? And so again, yields do remain elevated. We do think fixed income looks very attractive right now, just relatively. So we'll talk more of that, but I just kind of wanted to set the stage as we kind of go through the accounts, and then we'll hit on just more specific macro themes and just some interesting data points, we want to share. So again, looking at this, this is kind of the main account, right? The MRR account. It's the biggest by far. Kind of the breakdown here is, the equity allocation is about 40%. We're a little bit overweight there. Our target's 35%. Again, you're going to have drift. It's normal when we have environments like we had. As equity runs up, we're going to be a little overweight, but we are going to rebalance kind of back to target. Again, just trying to, cashing some chips in, taking some chips off the table, just kind of given the environment that we are in, and putting that really to work in fixed income. Again, as I mentioned, bonds are very attractive in our opinion right now, with high quality corporates yielding just north of 5%, depending on where you are on the curve. So you'll see some of that as we rebalance back to target. So we're a little overweight there. Looking at performance, so year to date, again, we kind of net up about 3.5%. Looking at like the blended benchmark, it's 3.4%. So kind of tracking right on it. Again, part of that's come from almost 10%'s come from the equity portfolio, and then not quite 1% on the fixed income. But however, again, we expect as the year goes on, that return should bump up a bit because of the income it's producing. So again, that takes a little bit of time to recoup, but it's attractive now. Then looking at the last 12 months, the account net is up about 8.9%, and then blended index about 8.4%. So doing well there. And then part of that, some of that's the equity piece there. That's given us a good return. Bonds at 3.6. What's kind of helped us with this is we have kind of started to shift a bit more. We did a little bit more shifting into international emerging markets, which again, until recently, hasn't performed well relative to the US, but we are starting to see that reversal, especially present in emerging markets. A lot of tailwinds going on with how they're positioned in supply chain, with kind of this tech build out, and as suppliers are, they're going more outside the US. And so we're starting to see that broadening out. So again, we've got a good year so far. Again, we're always prudent. We want to make sure we're controlling risk. So we'll do some rebalancing in this account as well. Looking at the risk reward, right? So this is, we always like to show this because again, we remind, people, we obviously care about return, but we're, as portfolio managers and stewards of your money, we're equally, if not more, focused on risk, right? So when you look on this spectrum here, you can see, the bottom here is risk. So the further you're out here, the more risk. And this is return here on the left on the, the y-axis? Yeah. Going back to school there for a second. Is the returns. So, you can see, just for example, this is the Russell 3000, which is basically the all cap index for the US market. You can see, obviously, it's got a higher return, but it's also a lot further down on the risk stream. So it's up there. Your account sits obviously, lower on that, with us being about 35% equity as a target. Longer term, we're, going to be lower than that, but we're getting good return for the risk we're taking. So we're happy to see this. Kind of looking at the breakdown of this is more of our individual stock portfolio. So we do have a combination of ETFs and individual stocks that we use to kind of, build the overall portfolio. So just looking at more of the US large portfolio that we use. And again, you see in other accounts that they're ETF models because of the sizing of the equity. We can only really use more of these active individual strategies with higher dollar amounts. So this account obviously is one that we're able to do that with. But I just wanted to make a quick note that this is just looking at that portion of the portfolio, not the whole. So when you see these numbers over here on the percentage signs, they're a little bit higher, but that's that's not representative of the whole portfolio. It's actually lower. So just a quick note there. But a lot of numbers on this page. I would say for us, the main thing I wanted to point out was just you can see how we're just underweight that tech space, as I mentioned, right? So we still have a large allocation. The the companies, those large mega cap companies, they're still great companies. They still generate very healthy profits. They have a large disproportionate share of the earnings in the S&P. They generate a lot of free cash flow. And they have multiple business segments, right? So they unlike something that unlike kind of the 2000 in the tech bubble there, a lot of those companies were they were funded on debt. They had a lot of they were not profitable, obviously. But in this day and age, these companies did fund a lot of this with cash flow. Now we're starting to see more debt issuances, which we'll talk about later. But for the large part, they're generating healthy profits. They're funding a lot of this through their free cash flow that they generate, and they're much more mature companies than like a tech bubble, which is kind of the last time we've had this big boom. So again, we own them, but we just want to control risk. We're not going to own as much as the market does, and we're okay with that. And again, that's turned out this year to be good moving into more emerging markets. But you can see the underweight we have at 30% versus the index at 38%. And then also just a little bit more in industrials. So that's kind of where our little bit of a more overweight is relative to the index. And that's really just the reason for that is really just the theme around continued spending on infrastructure and also just defense, right? So things like Boeing and Raytheon are two positions that we feel good about just because we've seen a lot of increased spending. Just as things as we all know, we watch news every day. Unfortunately, that's the world we live in, and so again, those companies are tend to benefit obviously in those situations. So the other main highlight here is just looking at kind of how are we overall positioned relative to the market? Are we more aggressive? Are we more conservative? Are we neutral? We're a bit more defensive. We're a bit more conservative right now. So if you look at the S&P 500, it's got a beta of 1. So anything that has a beta equal to 1, you're going to be as sensitive to the market, right? So kind of think about the same risk profile almost as the market. Anything higher is going to be more sensitive. Anything lower is going to be less sensitive. So we're a little bit under, which just means we're just a bit more defensive, right? Just in this environment that we're in, we're a little bit more positioned that if there were a pullback in the market, we're going to be a little bit more well insulated than the S&P, all else equal. And again, that's largely due because we just don't have as much concentration exposure to tech. Looking at the fixed income side here. So again, one of the things we have been doing is we've been extending duration a bit. So if you were to look back over the last year or so, or year or two, we've pushed this out a bit, which has been a good move. Where we're capturing yields that are higher. This account's large, and we have the liquidity needs kind of taken care of in the short term vehicles that we have, but pushing out duration's been good. We just think locking in these high yields right now is a benefit, especially just in this environment too with equities and a lot of volatility there in the market. And again, the majority of it's in corporate bonds, right? So again, we just feel like obviously buying high quality corporates, we're going to get more yield than a treasury. And that's kind of what our team does really well is being able to identify good quality bonds to buy that can yield us more than treasuries, right? So bonds again, good spot to be in, but that's kind of the breakdown there. Okay, that kind of set the stage for a lot of just general talking points. But what I'll do is I'll kind of go through these accounts next. So the IRF account. So one thing I'm going to point out right away is that this cash balance is way above target. That's more of a timing issue than anything. We had a lot of bonds roll off recently, and so when we had when that all happened, obviously there is cash there, but about 200,000 of that I know we was already invested earlier this month, and I know we have other outstanding orders out there to put that cash to work. So again, that's a lot higher than the target, but more just again timing issue with bonds rolling off and reinvestment into the back into the market. But as far as the target allocation, we're pretty much right on equity. It's about 10%. And that's what the target allocation is. So again, you'll see a lot of this cash go into this fixed income bucket. And again, about 200,000 of that cash already was put to work, and there'll be a nice other chunk getting invested probably over the coming weeks as our bond traders find opportunities. One of the things I did bring up with Dave and prior, and I think what we'll do is probably just have a meet to talk more about IRF, the IRF account in general with the cash. So one of the things with this account is it always has had a natural cash drag. When you look back at the prior years, there's quite a large amount of inflows and outflows. And they're kind of various. And so for us, there's kind of always been a higher cash balance in there due to the target because of the moving parts with inflows and outflows. For example, there was $350,000 last year of withdrawals on that account, and like that would represent 25% of the account. So what I would like to do is get with Dave. So I think we can better optimize this. So I would like to, get with Dave to try to get an understanding. Hey, if we have some more predictability on when these flows are coming in, coming out, we might, consider tweaking the allocation slightly on cash to make sure we're in line. But if we have a good understanding of that, I think we can then better use that cash to work instead of having a little bit of a buffer, because that has been something in the past that we've noticed why it's been higher. And you look at the account performance, it's just been a little bit of a cash drag because the net is 1.8% versus the blended index of 2.6 and 4.5 versus 5.8. So that's one of the things I think we can better optimize there for sure. Again, IRF account looking at mainly fixed income, again, because of the liquidity nature and just the inflows, outflows, and draws, we keep duration pretty short there. So it's going to be, a lot less and a little bit more in treasuries. Again, that just helps control liquidity needs, taking a little credit risk off the table if we do expect, a lot of outflows. But again, I think we'll probably want to look at this a little more closely and come up with a better plan to optimize that cash. Going to the ERF account. So this is account, but that's kind of set more aggressive, right? So it's our equity target's about 70%. We're a little overweight just given the market environment, which is again normal. And then obviously the fixed income cash bucket, 26% and about 2% on the cash. Again, that's going to ebb and flow, dividends, interest, etc. Looking at the performance. So one of the things we did, we did kind of do last year was we repositioned this, given the small account size, we did move this to an ETF model. And that was to gain way better efficiencies and diversification. We were kind of using our individual stock model and and rounded out with ETFs on the international and small space. But just given the size, it was we noticed we were just getting a lot more tracking error than we wanted, and it's just a lot more efficient as our team is kind of starting to build out more models with ETFs with our firm's best thinking. We'll want to probably implement that as well. We kind of just used a more of a passive approach to focus on cost, but we do think there are pieces in the in the portfolio that we can add some more value to, especially in the international small case, and those markets are tend to be less efficient. But these are all new developments at Corient as we've had our investment team, working on a lot of these solutions for our clients. So I think that's more to come there later in the year. But just FYI, we kind of switched that model to an ETF model just to gain more efficiency. So you can see year to date net about 8% and blended at 8.4. And again, this account is more heavily invested in equity. You can see the last year to date 11.6, and then last 12 months a little over 24. So again, just strong equity markets overall. Just going down in the interest of time. So the MRRB account, so this is definitely kind of wanted to bring up. So what we did with this account is, our long-term target was 60% equity, 40%, fixed, in cash. But we flipped it on its head at the beginning of the year. So we flipped this target to 35%, and that was really due to, obviously the potential for a project to go through with the pool. And so we said, we really need to think about taking that risk off the table. And if we think that that's actually going to happen, and we know that could be, we might need cash later in the year, then we wanted to make sure we took the equity risk off the table. A lot of so about, of this breakdown in fixed income, about $500,000 of that fixed income, so a large chunk of that is in bonds that are maturing soon, and a short-term bond fund that we had earmarked for these cash needs. So, I think, again, one of the things we'll do maybe is get with Dave and say, okay, what is the exact dollar amount we need from the account? And then we can then go ahead and, probably take some from the equity to rebalance, but then also we can liquidate the remaining fixed income and move that into cash and just have that, in a money market, type vehicle or move it to JP Morgan, whatever the preference is there, just to have ready to go. So that'll be something we'll want to do. The performance, this is going to be all over the place. And again, some of these blended indexes, again, our system, we have limitations with basically, there's been multiple allocation changes in this account. And so one of the challenges is that our system can only, use one blended benchmark. So as all of these different changes have occurred, we're not able to capture all those changes. The blended index that we're using here is assuming that we're invested at a 60% equity, 40% bond, but that's not the case. We're obviously much more conservative. So this is not a good comparison here. But we left the blended index in there as is, since we viewed this as a temporary adjustments allocation. We didn't change this, but I just want to make a note that that's just not an apples to apples comparison, because we made that change earlier in the year. It was temporary. The blended index still reflects that we're at 60% equity, not 35. So that's kind of the punt. Before I get into the commentary here, what questions do you guys have just on the accounts? Anything?
Well, I think with with the outgoing of cash that we know that is coming down the pipeline in the next few months, definitely we'll probably need to get together to make sure we can meet those cash needs, along with getting the most bang for our buck before we need to spend it. So
Yep.
yeah, probably need to get together to just kind of do a timeline on that. I just got some additional information in the last week, so on a lot of that. So we might be able to know exactly when the cash is going out the door, at least for South Borrego Pool.
Okay. So Dave, would it be helpful, maybe just myself, John, and you get on a Zoom call maybe sometime in the next few weeks to maybe chat through that more, because we want to get an idea of when those cash flows are, because we need to, we just want to make sure we're positioned. We have, we're maximizing yield, but we also need to make sure our liquidity is good.
Yeah, I think that'll be good, and Howie, we'll want him to participate in that as well. But yeah, and I'm gonna probably have several more meetings on our cash needs in the next couple weeks, because we're starting our budget process as well for the next year. So I'll be able to have a lot more information. I'd say at the beginning of August, probably.
Okay. Maybe we can shoot for a meeting then sometime in August to do that.
Yeah, I think that'd be good.
And I want to talk, and we want to talk about that IRF account too. I want to see if there's a way we can get a better understanding of the cash inflows and outflows, because they're pretty sporadic and various from years past. So we just want to, I think we could just do better there. So I want to talk through that more with you.
Okay, that sounds good.
All right. Anything else?
Carol has a question.
Yeah, and it's really related around this issue of cash. Right now, what do we have? $4 million in cash that we just sort of have for an emergency, right? It's a huge chunk of money compared to, for example, the pool fund.
Mm-hmm.
And this is not something for our advisors. This is something for our board and the investment committee, really. And it's a shame there aren't more people here, but have we even considered taking some of that $4 million and using that to fund the
Well,
pool, this particular pool, and keeping an investment bunch of money available
No,
in
because
B?
it's pretty specific on what each of the funds are specified for. So,
Well, and there could have been some lack of knowledge about the funds earlier in how some of these were set up. And I'm just asking, you're new, Howie's a little bit new, but thinking about, we've got a lot of money and we've got to be sure we put that money where we get a reasonable return for the risk we want to take for that money. That's my only
Right.
point. And don't forget that $4 million, that's a lot of money that really came from dues and capital funds way back in the teens when we had more money than we were spending.
yeah, we are monitoring that most definitely. So, again, we're just meeting with the staff to go over our short-term and long-term for the next year
Mhm.
of what we're going to be tackling, because we have already approved a couple larger projects, I believe. So
Okay,
we want to make sure we're set for that.
understand.
I'll add,
Thank you.
it's okay, yeah, you make a good observation on the 4 million. But to maybe give it a little more context, and the way we look at it or try to manage it is that's both split up between our operating and our reserve funds. And in our operating account and Kevin's accounts, the JP Morgan, we're really targeting that 90-day cash target. And we're going to draw $1 million or $2 million on our operating accounts up until we start collecting. I don't have the exact number or what we expect, but it'll be in our FAC packet, I think, when we put that out. So a large portion of that cash is to satisfy that 90-day rule in operating.
Well, it might be that the 90-day rule is flawed,
Well, that's a separate issue, though.
Well, it is, but-
We're managing to.
but it
We're
causes you to make potentially decisions that hurt the overall investment return
It
of
might.
our major accounts.
I would concede that, but from our point, the managing of the 90 days to make sure we have try to make sure we have that 90 day in cash reserve, in November, basically. And
But why hold the 90 days in November when dues start coming in November? That's the whole point of I am,
fair.
you'll know I'm a very conservative, actually, on the financial basis. But we're very different than a lot of nonprofits. I mean, if I were a YMCA counting on the goodness of my members to pay a membership fee, that's a totally different situation than GBR.
Yeah, I appreciate the perspective. I guess just my main point was to separate the operating and, we should discuss operating cash on its own versus the cash we have in our reserve on their own.
Well, potentially.
We have our own
and Steve
controversial ideas.
Steve had a great idea about ways to get more money out of those operating funds too. I mean, if they're just sitting in a less than competitive short-term money market, we can do a lot better than that.
That's fair, but I'll point out, we're ahead of budget on our investment income for the year. And, although we're trying to balance things, we're really trying to manage to our budget. And from my point of view, whether we could do better or worse, I'd like to always do better. But when I just use the budget versus what we're doing, like, yeah, I'm like, good job, Kevin. Good job, John and Brendan.
Well, you guys are ahead
There's
of
more
that.
to it than that. I believe
Right,
you.
right. And
understand.
I would far
understand.
rather make an extra 0.1% in our investments than charge our members
Yeah.
an increase in dues.
100%.
I
Yeah,
mean,
exactly.
that's just where I'm coming from.
Well, and that's the objective of all of our investments, to make sure we get the maximum amount of return, but there's that risk and reward and
Absolutely.
balancing that. So,
Absolutely.
so yeah, we're monitoring it and gonna continue to focus on that, especially with, knowing what projects we have coming down the pipeline. And as those get more fine tuned, then that helps us be able to fine tune other things as well.
Yeah, and I know you guys,
Yeah.
you're sort of the end of the stream. We spend money in kind of erratic steps and almost never spend as much as we think we're going to spend, and we stay under budget.
Yeah, that's why we are living it every day. So, but, yeah, so Brendan has his quarterly market commentary to go over. So,
Yeah.
oh,
And yeah,
before Kevin, before you, or Brendan, before you continue, just want to make sure. Steve, did you have anything to add on that?
No, I really didn't.
Okay. Just want to make
One
sure.
of the things that always
you
scares me
included.
is when we start accumulating a large cash position, because every year we elect a new board and the new board does whatever it is that they want to do. And when they see a pile of money sitting there, I get the jitters.
yeah, yeah.
Yeah, because I agree with that. We've actually, I've talked to Scott about that too, of just the diversity of the board from year to year, and kind of us having to balance that, because it seems like it fluctuates quite a bit,
Yeah.
which
And
isn't a bad thing. But it makes expectations, kind of ebb and flow as well, kind of like the market,
Yeah.
you know?
so I think both Carol and Steve make good points and good comments, and Dave, one of the things, and Howie, one of the things about Corian now is, our services have greatly expanded. So like something that we can help, and this is all inclusive in our fee is, we help a lot of clients with cash flow planning. So if it's helpful to have, myself, review some of this and maybe come up with ideas, I'm more than happy to do that. Again, IRF, I think is a good, kind of a good example of it. It is a bit sporadic, and there are some journals that flow from account to account. So, I think working with you, I wonder if there is a way maybe we could be a little bit more efficient, just on our end even too. I know that the cash outside separate, but I do think that is, it's a good point. And I just want to let you know, I am here to help with all that. And just, be a sounding board even, but just also try to come up with ideas as well. To see if, hey, is there a way that, I know, this is the way it's been done before. Is there a better way to optimize things so that, we don't, so that some of the cash balances can get utilized. So just wanted to throw that out there.
Okay. All right, most definitely.
Great. All right. As you guys know, kind of the and I'll try to, I know I'll be respectful on time here. So looking just, some of the themes out there, right? We always like to kind of share kind of insights and then kind of what we're seeing, what we're looking at. This year, obviously we mentioned inflation. That's obviously back in the picture, right? It was never completely down to the Fed's target, but obviously the spike in oil prices, yields, and some uncertainty around there. We went into the year, if you look kind of where this is here, went in, end of the year thinking, okay, we might have two rate cuts, and it pretty much flipped on its head. And now, looking at today, the market's pricing in, anywhere between 1 to 2 cuts. I don't like to focus on that too much because this is such a moving target here. It can change quickly and rapidly. But again, just with oil and energy prices, that's been kind of the main reason. When you look through it though, and you say, okay, higher oil prices and inflation, what's kind of the actual impact? Well, it's part bad, part good. I think the sad part is it affects it affects a disproportionate of people. So people that are in the lowest household incomes get impacted by far the most on inflation. So if you look at this chart, it kind of breaks out basically, what these various households, like from the lowest to the highest, what they spend their pre-tax income on. And you can see here that low income households, it's a very large portion of their income, right? Which means the higher this gets, the less they can spend on other things, right? You
Look at consumer borrowing. That'll answer that issue.
Yeah, yeah. Well, yeah, that's that's another thing as well, and that can cause issues with especially on the lower side of things where especially if consumer credit things like that. Obviously, that's always it's never good if people are having it to use credit cards more, things like that of nature that don't have the means, but also looking at the highest income households here, it's a much smaller portion. So what does that mean? It doesn't impact them as much. And, if you look at it's a bit more muted. And if you look at, what drives the economy, we're still a largely consumer driven economy. So, as we consume, that's a big driver to economic growth. And, this larger portion accounts for about 60% now of all the U.S. consumption. So, although inflation hurts, the lower class, the upper class it doesn't, and it doesn't. We're not seeing impacts to consumer spending. Steve, did you have a further question on that?
No, I didn't actually, but just wanted to point that out. That's all.
Yeah. Again, valuation is always something we're looking at. So still a bit elevated, at the S&P, but I'll tell you what, it's backing it up by earnings. If you, again, I think I mentioned this earlier, but just looking at this kind of point here, Q1 2026, right? The expectations are around 13%, and the actual is 28%, right? So again, that's it's not uncommon for it to beat expectations, but by a margin, like that. Obviously, if that's continues, that's going to create a lot of momentum. But again, that just sets the expectations even higher and higher, right? So as the bar just keeps getting raised and raised and raised, at a certain point, it's going to come under the bar, right? And that obviously will cause a little bit of volatility. But I mean, we've had, I think, over the last 6 quarters, double-digit earnings growth, which is extremely good. And so again, I always come back to this. Markets care about what our business is doing. What are they making money or not? Because guess what? They're making money. That goes back to shareholders. That's going to drive growth, regardless of what goes on out there. And so, again, despite everything that's going on, if we continue to see this growth rate, I think that's going to support us in this. That continue to support the momentum in the second half. So again, that's been a key indicator. And again, valuations still a bit elevated. We've had a little bit of a pullback in there, but again, still relatively expensive. Looking at what's kind of going on in the CapEx world with AI, kind of a fun chart here, but just looking at some of these historical historical items here. The Louisiana Purchase. When U.S. invested in all the railroad infrastructure and our highway system, space program, you can see the percentage of GDP, the spending as a percentage of GDP, 3%, 2% on the railroads, interstate highway 0.4, like those are massive projects, right? Massive infrastructure projects. The CapEx spend from a handful of companies, 4 companies, is 2.1% of GDP. So you can see that kind of tells you how much is going into it. However, we are starting to see productivity get stronger. So you look at kind of labor productivity, right? When you think about what drives economic growth, it's kind of 3 main functions. You have your labor force, you have your kind of your capital per worker, if you will, and you have basically technology is the third factor, right? So we have a decreasing labor force. We already have a high capital labor ratio. So we need technology to grow. We're in that developed economy where we have a lot of spending and investment. We need technology. you can see here, similar to, when the PC happened, again, this is the growth rate of that productivity, right? And so you can see, when we had the first PC and computer, you can see that the growth rate increase. When obviously the internet was huge, right? We all know that was revolutionary. You saw that big uptick. Again, as we fell, Great Recession happened, whatnot. Now, we're starting to see that adoption pick up, and it's actually getting picked up at a much faster clip than, these other kind of instances in the past. So a positive sign. Again, we're, still a lot of uncertainty on exactly how it will shape up and play out over the years, but it is nice to see that it is boosting, productivity, and quite frankly, we need it. What's been on a lot of people's minds, obviously IPOs. So, IPOs have been somewhat kind of muted over the last few years, but given, what's going on in the marketplace and in AI, there's obviously a few big ones, coming to market here, and one already has, with SpaceX. Sure, as you all know.
Humongous.
Yeah.
Took off like a
big.
rocket.
What's that?
I said it took off like a rocket.
Took off like a rocket and then came back down.
That's right.
Like his technology does with other rockets, where he brings them up and down. It's pretty wild. But yeah, that was an interesting one. Yeah, obviously we stayed away from that. Multiple reasons why. The valuation was, and it was almost laughable. It was trading at 100 times revenue, which is just about, it's very high. So what does that mean? Well, it's not really valued on fundamentals, really, and we're definitely more fundamentally driven than speculatively, driven, or however else you want to, put that. But a lot of it we thought was just Elon, people just wanting a piece of Elon Musk, right? He's a big name in the space, and obviously it's his vision, his thing. So a lot of that value in the company, I think, is more just speculation on Elon and, what he can do. But in our opinion, again, being more fundamentally driven, it's not profitable. At some point maybe it is. But also too, there's risk with, there's what we call key person risk, right? So when you're looking at companies, you want dispersed voting power, control, stuff like that. Generally speaking, right? Elon owns 85% of the voting power, right? Which could be good or bad, but if he gets hit by the proverbial bus, who else is going to run SpaceX, right?
Well, that does bring up a subject which I thought about, not just today, but we tend to use, well-established market indexes, which are all cap weighted. And, that brings with it, concentration risk that is pretty substantial today. And I'm just wondering if there isn't a better place for us in equal weighted funds.
Yeah. Using that as a benchmark, or like using that as,
putting our money in them.
Buying some of those, buying the ETFs.
Yeah, buying some of them.
Yeah.
There's some really good equal weighted index funds that strike me as being, since we're on the subject of conservative investing, I think that would be an example.
Yep. Yeah. And I think for us, we actually kind of have a little bit more of a structure like an equal weight, not exactly like an equal weight, but because we have these pieces of ETFs with, small caps, mid caps, obviously large caps. When you kind of put that together, it's a wide range of companies, much broader than the S&P, and definitely way less concentration. So when you do kind of look at the look under the hood a little bit, because we use ETFs to complement kind of the U.S. large portfolio. It does give us more exposure to, because what an equal weight fund is it's still large cap, but it's almost acts more like a mid cap, because you have equal weights on all those companies, right? You don't have 40% in 10 companies. And so I think if you were to look closely at more of our portfolio, we kind of are actually a little bit more like that. But always happy to take a look at that and provide some thoughts on it. And I think, again, as our ETF portfolios develop, our investment, we have a 125 person investment team now that, really does a lot of research into various, strategies and solutions for clients. I think, we can always introduce that as something, or hold it, somewhere else. But I think with our portfolio, we actually, we do control that risk pretty well.
Well, I'm really big into asset allocation metrics at the moment because I'm trying to spend less time on investing and more time on enjoying the last years of my life here.
There you
And
go.
there's
That's what
some
you got to
really
do.
good thing, the Harry Brown thing 30 years ago. I bought the book when it first came out, and I still kind of look at that, and I use portions of that. Of course, part of that is in precious metals and gold.
Uh-huh.
And I don't think we do that in GVR, although actually we probably should. But anyway, I think the whole idea of asset allocation is underappreciated. So I'll leave
Yep.
it at that.
Absolutely. And we are well diversified, right? So we do have kind of targets, right, on how much we want to have in large cap, mid cap, small cap equities, how much we have in international equities, how much we have in emerging markets. We are 100% in agreement on that. We think diversification and asset allocation primarily is going to drive your stock, is going to primarily drive returns, and everything else kind of under it is becomes less relevant. But asset
Yeah,
allocation is the biggest driver of returns. I could even send you our marketing slide on it to prove it.
sure, do
But
that. That'd be great.
um, awesome. But anyway, this just kind of goes to show here that obviously there's IPOs are quite volatile, especially when they come out. And if you look at just looking at just this last bar over here, over the 3 year, basically 64% of those IPOs return less than -10, like they're worse than -10%.
No, buy them
Um,
after they go in the tank.
yeah, exactly. It's more of a proven model, and then you have 7% kind of in the middle of -10 and 10%, and then about close to 30%, 29% there, return greater than 10%. And I think really what we're like the theme we've seen now with the IPO market, which is much more than a decade or two ago, is that companies are one, a lot of the value creation happens when they're private because either A, companies aren't going public, or they're staying private for a lot longer. And so a
That's
lot of the
right.
value is in the private space, which, again, those are some investments that we do have alternative investments. I think in your IPS, I think we're not allowed to utilize those, but that is always something we could use. The only thing with that is you just have to watch out for liquidity, right? Those are illiquid type of assets. There's a whole different kind of profile to them, but in the public markets, we find it, the IPOs are challenging for that reason. Again, they're just a lot of that's created in the private side. So you're kind of getting the tail end of it. You'd rather get the early part of it. So
But
anyway,
even the private equity companies that you can invest in are spinning off 10% or so. You're pretty good.
mhm. Yeah. Private returns have been very good. I do think they could be. I think they were in an environment too, though, because private equity uses a lot more debt, a lot more leverage than public markets, and so I think they were big beneficiaries of very low interest rates for that time period. Now with rates higher, it affects all companies' cost of capital. Don't get me wrong, but I think private equity returns, we would expect them to be a bit lower than historical, but still still above the public markets, right? Because there is
Yeah,
a premium for
there
having the
is.
illiquidity, right? So
That's right.
yeah. Um, Looking at international equities, right? So again, this is an area that we've kind of actually started to piece more into diversification and that asset allocation, Steve, as you pointed out earlier, right? So we do like international equities right now. We have a target of something 20 to 30% is kind of our investment committee's movement towards kind of international equities. And if you look at the reasons why, and I mentioned some of these earlier, but one, it's a hedge against the dollar, right? There's some concerns about it. And that actually enhances international returns as a U.S. investor. But the other piece really is valuations, right? You look at just how these look on a relative basis. This dark blue line is just internet like developed markets. I think Europe and Japan, and then kind of this lighter shaded line. I wish they kind of use different colors, but is the emerging markets, right? And so both of those relative to kind of historical norms. Sorry, when I mean discount relative to the U.S. So the U.S. market always trades at a premium to international, so that's normal, but we're seeing it at a way steeper discount than normal. And again, these companies are they're trading, the profits and the earnings growth have been, have been great. And you're getting them at cheaper prices. And so we do think there's a compelling reason there, along with some of the thematic, some of the themes out there with, the increased, spending and fiscal policy that's happening, abroad and whatnot. So we do think there's some good, tailwinds there on that side. Again, we're not making a huge bet, moving a large portion, but we are kind of piecing this in, and we have been over the last year or two. Looking at kind of the bond side on fixed income, so kind of focusing on this left-hand graph here. So at the blue here, that was at the start of the year, and then kind of that's where we are halfway through the year here. So again, big move in the curve. I mean it was quite a big move earlier this year. And again, the Fed controls this portion of the curve, right? The very short end. And the market controls this end, right? As you start to go out further, that's what the market controls. And so what does that mean? What's the market saying when we did see this move really across the yield curve? Sometimes it's just in one area of the curve, but it was in everyone. And it's really what that's saying is, one, we have obviously pressure on inflation. There's been a lot more bond issuance from kind of the hyperscalers in the AI space, which before, as I mentioned, a lot of it was funded through free cash flow. That we're not taking on large amounts of debt to do this. Yeah. Starting to see that now, which again, that's increased the risk profile a little bit on that front. And then obviously just looking at fiscal issues on our end with deficits and stuff that at some point we'll have to get figured out. But I guess everyone likes to table that one. But again, with fixed income though, starting, if you're positioned well, and again, we're quality on the bond side. We're not high yield. We don't have any. We want the fixed income to be the stability, the stabilizer. We're not trying to hit home runs and try to generate super high yields, because that means you're taking on more risk, right? So the more you move into higher yielding income or bonds, the more you're correlated to the stock market. Right. They start to act like stocks more. We don't want that. We want stocks to do what they're supposed to do. We want bonds to be stable and provide income. Right now, they're doing a great job of that with yields higher. So even with the big move that happened earlier this year, and bond prices shot down, it's already overcome that because of the income that we've had over the last few years when rates went up and we were investing in those bonds then. They're attractive right now. So that's kind of the punchline there on the fixed income side. And again, the corporate kind of just fundamentals in general, and credit risk remain pretty low right now. So that's always a good sign. And again, we have a pretty good economic backdrop right now. So feel pretty good at where we're at. So yeah, just kind of looking forward again. I think some of the kind of main things again, Iran probably the biggest. Just seeing how this, I read headlines and I don't know what's going on over there. I'm not there, but it kind of ebbs and flows. But that's obviously again a primary factor. I would say just again with the Strait of Hormuz. That's that accounts for 20% of the global supply in oil, right? So that's a massive deal when you're looking at just looking at from a global perspective. So we'll see again how that deal develops, and obviously if oil prices can remain contained, that's a good thing, and that's going to cause the Fed to then it's going to lower the pressure on the Fed, and maybe potentially we're going back to a neutral position, not necessarily wanting to do a rate hike. I think that would obviously be an adverse impact there. Again, upcoming IPOs, we're going to see a lot of stuff coming out on companies that are going public, and they're really a lot of them concentrated in this AI space. Anthropic, OpenAI. Not sure of the exact details of all those, obviously, but again, IPOs, as I mentioned earlier, have quite a bit of volatility early on, so we tend to stay away from them. Over time, you let it play out, and if fundamentals make sense, we'll we'll be buyers, but not likely in your guys' account today. And then midterm elections, that's going to kick in, obviously here a little bit later in the year. Historically, that, always causes quite a bit of volatility. Actually, on years that were in non-midterm years, markets tend to do better. But again, when you start to look over the long term, it's really just noise for more of a shorter term period, and things do level out, because at the end of the day, markets care about earnings and fundamentals at the end, when it's all said and done. And that's kind of what I mentioned before. But one thing with, again, just to mention with the markets, markets like gridlock, they like some sort of balance where, we don't have a full sweep anywhere on between the House, Senate, and the president. So for us, we as investors that are not political and neutral, we like when it's gridlock. That means it's harder to get things done, which again creates more certainty for us, and it tends to be better for the markets. So that's kind of all I got today. I don't know if you guys have any closing comments or questions.
I have a question.
Sure.
Thank you for the update, Brendan. I have a question. You're a larger expanded firm than when we first hired John and the company. And lots have changed over the years regarding asset allocation. Has your centralized investment committee changed anything from the, sort of the old 60-40 allocation, which everybody preached 10 years ago?
Yeah, definitely. I would say, for what's different from what you experienced with Denver, Denver Investments, right? At Denver Investments, right? I think they were So I think what's changed there, a few things. One, kind of primarily be having more of a diversification and allocation in international stocks. So that used to be somewhere around 10% historically, kind of on that side, but over time it's moved, kind of closer to 20 and 30. Again, that that's starting to pay off now, but just given where the market environment's been in the U.S., there's a compelling reason that we felt to move more into international stocks, right? And so not only just because they're more attractive, but also they're starting to have a little bit less correlation to the U.S., which is good. Before, the correlations were actually really high, just with globalization and whatnot. So that's been one big change just in the total realm. And then starting to introduce a little bit more in the small cap space too. So that premium has been gone for quite a long time, which is funny, right? You think about a small cap should do better than a large blue chip company, right? Because there should be more growth potential. But given just the landscape and the market dynamics we've had, which again, highest concentration levels we've ever seen. The second highest it's been was the tech bubble, but because of just how I think the industry's changed, and there is a lot more use of, I'll call it rules-based buying, like index funds and stuff. So I think companies naturally get a lot of the flows into those funds. And so for us, it's just, again, become more concentrated. So we've moved a little bit more into small cap space as well. And so our IC kind of allocation versus what it was when it was primarily U.S. large, our investment committee has put together, it's about 60% on the U.S. large side is our target, and then about 10% in small cap, and then about 25% in international, and 5% in emerging markets is kind of where we're at now, and that's developed over time. Is
that for both equity and?
That's just equity. Yeah, just on the equity side.
What about this overall 60-40? Have you changed that ratio?
Yeah, are you talking about on your guys' accounts or just in general, or just kind of
in general? That was, you read it in all the textbooks. Everybody said John told us that when he first came.
Yeah, that's your class. It is pretty classic. That's changed a lot. So I would say with, obviously we work with nonprofits and also private and families, right? And so on the family side, I think, something that we've done a lot, we've extended on that 60-40 is we have done more alternative investments. The punchline there is that there's a as I mentioned earlier, companies are staying private for longer, and some companies aren't going public. If you looked at the Russell 2000, which tracks the U.S. small cap space, 40% of those companies are not profitable. What we've seen is they get all bought by private equity. So a lot of the companies don't IPO because they're getting, the good companies are getting bought before they're hitting like the index, right? They're going IPO for the public markets. And so for us, when we look at diversification, right? If we have a lot more companies in the private space than there now are in the public space, and I'm not talking about garage bands, I'm talking about companies that have billions of dollars in revenue, right? Big companies that are staying private. Well, for us, we want to extend our opportunity set, right? If only 15% of companies that generate over 500 million in EBITDA are trading in the public markets, and there's 85% in the private, we want to get a piece of that, right? But there's other trade-offs with that because alternative investments are not liquid, right? So you need to be careful about liquidity needs and which accounts, right? But for that reason, over time, they provide a premium over the market, and they're they're not less risk. I'm not going to say that. You're going to find people that say they're less volatility, higher return. That's true, but I want to caveat that it is risk. It is, and I would argue it's higher risk because I don't agree with anything that risk and return to me are correlated, right? But the way those assets get priced are not like public equities, right? You have factors in the public, if you want to dumb it down really to primary factors that affect the stock market, right? It's fundamentals, right? So company beats earnings, the stock's going to shoot up. If a company misses earnings, it's going to go down. That makes sense, right? Macroeconomic variables, right? Interest rates, big one, right? That affects companies' cost of capital. Those things. Those two things still impact all private investments. But what private investments isn't subject to is the third thing public equities are, which is sentiment, right? It's it's based on how do people feel in the marketplace, buying and selling, right? So in the public markets, when you have COVID's a great example of when you had people that were scared and nervous about what was going on and selling all their positions, all the positions fell. Well, in the private markets, it's based on fundamentals and it's not subject to that daily volatility, which again, I think is why you can get the outsized return, because in those environments, those private equity managers do their best work because they're buying assets at way lower prices that everyone's selling. And that's one area. So I would say it's a great question, Carol. And I would say for us, we have broadened out that stream to more of not the 60-40, but more of a public equity, public fixed income. I'll call it this, public growth equity, public fixed income, private growth equity, and private debt too, right? So it's kind of multiple things. So we have added those in. For you guys, we do have, and I think we'd love to talk about this more with you guys if we think it's a good fit. But we need to consider liquidity. And I do think at Corient, with how we're structured, we do this really well for clients on the alternatives. We have a 40-person team that's all they do every day is try to find best-in-class kind of managers and deals. We did not have this at Denver Investments. We wouldn't even be able to sniff some of the access to managers that we have today because of our start. We just didn't have the scale, right? Now at 500 billion of assets, we have the scale and the way our partnership model works to do it very efficiently and effectively for clients. And one example is we just got into one of Jeff Bezos's AI funds but again, that's charity. Nonprofits are different rules than individuals. So I don't want to get off track there with you guys, but there is a solution for nonprofits. It's something that maybe we can consider, but I don't know with your IPS states that we can do it. So that would be the only thing.
Yeah, one of the things that I hope this new investment committee will do is take a very close look at the IPS, because it was heavily based on the view of the market 10 years ago. And I do believe things have changed. We also have a new CEO. We have Howie, who's done a great job bringing some real financial knowledge into the organization. And I think it's been quite a long time. It's time to reassess where we should invest. And I'll tell you, in a little organization like GVR, having $10 million, $12 million in assets is very unusual. And every
Mhm.
0.1% makes a difference
Mhm.
for our members.
Yeah,
Well, to
absolutely.
Carol and the rest of you, if you want to include me in that effort, I would be willing to help.
Well, you're on the investment committee. You're the key guy. I'm not even on the committee. But I'm happy to provide ideas and everything. And I just think it's a time to sit down and rethink this whole approach. And it sounds like between Kevin and Brandon, we've got some people willing to really help us bring some newer ideas. And
I'm
and
gonna
not
close the
anything
circle
from
on
Todd.
this.
He's done a great job for us, but
I'm
10
gonna
years is 10 years.
close the circle on this a little bit. I use AI in my own personal investing and find it to be exceedingly helpful.
Yeah, good.
I would think that the investment committee could do likewise.
Mhm.
Mhm. Yeah.
Absolutely. I think it's a great idea. Yeah, because if it's been that long, and it's kind of, use old language, I think it totally makes sense to kind of take a clean sweep. And I'm more than happy to even just look through them and provide my insight again, along with the looking at the cash flow and trying to help, figure out, hey, how can we help, manage that better, optimize it, and just, coming up with ideas. So again, we have the resources to do all that. So I'd be more than happy to take a fresh look at it, all of it.
Okay. Yeah, thank you. Just in the interest of time, since we're at the end of the 10:30 allotment, we've got two more agenda items to go over, so I'm gonna move that we go to those for now. And Kevin and Brendan, you guys can probably drop off at this point because it's the education material and one of the recommendations that we're gonna suggest to the board. So do you guys have all your questions answered by Brendan and Kevin?
Yeah.
Okay, all right, fantastic.
Thank
All
you,
right.
guys.
Have a nice day, everyone.
Yeah,
Thanks for your
everyone.
time.
Thank
Good to
you.
see
We'll be in
Kevin.
touch with you
All right.
guys. All right,
Bye.
take care. Bye.
That's a nice segue.
Segue, yeah, I just, in the interest of time for us, one of the reasons why I included the education documents that I did is just kind of as a refresher for the committee to review them. And to Carol's point too, is do we need to revamp it at all? And I think probably in the next quarter, we can get that communication out to the other investment committee members to just have them kind of throw their ideas together. Usually the chair is the person who will coordinate all of that. So I'll work with Bart to see if that's something he wants to do, or if it's something that Howie and I will take on. But really, there's nothing that really stood out in there. We were looking at our percentages for Q2 and we were slightly out of compliance, but that was really a timing issue because of the cash and the short-term needs and them selling the bonds before they reinvested them. So I think we're good there, but it is apparent that I need to just continue to meet, or Howie and I need to continue to meet with them on a regular basis to let them know about the status of the projects that have been approved, where they're at. We have West Center, the lapidary, the lobby. Those are very big projects, big dollar projects. We just signed the South Abrego Pool contract last week, or actually earlier this week. But seeing those details, that kind of gives us a little bit more direction on what the cash needs are going to be, what the timeline of those cash needs are going to be. And I think, understanding the earlier in January when the board had voted to reallocate MRRB to 65% cash, probably was a little bit early for that just because it hadn't even been approved. But I think it's good that Corient didn't throw 65% into cash, because we really would have lost money there. So it's a good thing, but I do think a lot of this needs to be revisited on the CPM and the investment policy piece of it. But just probably like updating the graphs. The 90 days cash on hand, that's pretty industry standard. But I think we can look at that a little bit more. That's one of the things that I've been thinking about. Is do we have too much cash in there? With it not earning as much, that's been one of our thoughts. But then that's going to lower our days cash on hand considerably. If just as an example, if we took $1 million out of that, moved it into one of the other funds, which I know we would need the board's approval on that. But we've got a lot of things to discuss, decide on what we want to do within this next year.
Just to give you a little history, Dave, that 90 days cash was basically one person fighting very hard and very passionately to get that into the CPM.
Yeah, I think.
And it's not, and if you look at what we are versus what she was trying to protect, I have no problem with 90 days cash when you need the 90, but when we know that we're going to get a huge cash infusion by law, right?
Mhm.
And even,
That's right.
even
Yeah.
if people just refuse to pay because they get mad at GBR, we'll still get 80 or 90% of that money. So why
Right.
not say 90 days up to September or even October if you want to be super safe? But you
Yeah.
know that you can work that down because you're getting money.
Mhm.
That's,
Yeah,
and I
do
know
think
where she
we've
was
been looking
thinking.
at that. So,
It just, so don't think you have to, the CPM, that didn't used to be in the CPM. We can
I
change
think
it
it's
again.
absurd that it is in the CPM, to be
Oh, I
honest.
agree with you totally, but I just want these guys to realize that I think with a logical explanation, anything in the CPM can be changed.
yeah, and that was, I guess that's a good segue into on the business item D. So one of the things that, I just, and Steve, if you want to go to, I believe it's on page,
Oh, I didn't print it out.
oh,
78.
78.
Page 78.
Yeah, let me, I'll pull it up and put it on my screen
Okay.
here.
That's nice. Thank you.
Sure. Let's see. And so let's get to page 78 here. And really, when I was looking at this, I really was feeling like we're mostly almost handcuffing our investment advisors. So that's part of what I was looking for on this is in the background justification of adding maybe out of compliance temporarily due to the short-term cash needs. Because, the one thing when I was talking to Brendan the other day about this was that, really they're being told, they have to have X amount of dollars ready to go. And then we're kind of piecemealing that
Yeah.
as the invoices come in. Because, the projects aren't over in 30 days. They're usually, a lot of them are half a year to a year, depending on the scope of them. So we don't want to get penalized for them having to cash out early.
Mhm.
And that's part of what I was feeling like we needed to have that asterisk out there so that it just gives them a little bit of flexibility. And if we see those variances, being skewed so far out, then we can kind of rein it in or ask the why behind why is it out of compliance? And if it's due to, like, at the end of June where they sold or they had bonds come due and they hadn't, reinvested those immediately when they got the cash in. Because I don't want them to have to scramble to get and then make a bad decision.
Mhm.
I want it to be very thoughtful, intentional. And really, Howie and I are stewards of this money, so we want to make sure we're doing the best with it,
Mhm.
for all of us included. So,
Well, Dave, again, I say 10 years, it really wasn't. We started looking at other investors 10 years ago. I don't think we decided until, I don't know, to 18, maybe nine. It took us 2 years of really trying to think through, why are we sitting on this huge pot of money and making nothing off of it, right?
yeah, yeah.
So
Well, I can answer that. We were scared to death by some of the stupidity of our previous investment advisor. And so we were exceedingly deliberate.
Right.
Okay.
So, yeah, and we spent a year interviewing folks and looking at
did, that's
proposals. So we spent a lot of time.
Yeah.
The thing that I ask you to think about, and I think it's the investment committee's job to think about it, is cash, operating cash, and investments. We've got so much cash, right? And yeah, the market could fall apart, but you look at what they're invested in, they're pretty, and it's longer term, Microsoft, sure, it might fall 30%. It already has, or 20%. But over time, it'll come back up. And so many of our investments, or at least it was my objective, to have a nice big pot of money. So things like maintenance, we really didn't have to worry about the maintenance. I mean, sure, some years we're going to feel pretty bad because it all comes at once like it always does, right? But other years we never spend, right? So we build it back up. And if we invest it well, we'll be just great, being a little more risky in our
Yeah, we
long-term
can keep
investments. But
dues.
cash, I understand the
Yeah.
90 days totally. And I understand being conservative with cash. But again, I think I'm asking you guys to fight for every 1/10%, because that's a lot of money. And we have a lot of money in GVR, right?
Right. We do.
I mean, we
We do.
do. So we ought to
We're-
get some of the
We're a
best
very
rates.
healthy organization, most
Mhm.
definitely. Yeah, so Steve, what are your thoughts on adding that, at least initially would you be okay with us recommending that to the board?
I would say that we're on the path of having excellent investment management, and we should give them a lot of latitude to do their job.
Okay, yeah, that's really what the point of that is. It's to not keep them handcuffed to just being so tightly controlled by those categories. But I think, with having the ranges, that's a good thing. We have our targets and
Mhm.
they really need to be within.
It's really, and I've been doing this now for a while with AI. Take your asset allocation model and put it through AI and say, what would this portfolio have done in terms of performance, return, and maximum and minimum, numbers, and see what it says. And you'll find out that a reasonably good allocation has a minimum drawdown and only very temporary. And like 2008 was a big hit, but it was very short-lived. Really, the risk profile that we're taking sort of hurts us in some of these ways.
Yeah. Dave, if I could we have a new board. It's a very new board. You could use this as a little bit of education too. I mean, particularly if you've got some real numbers. And I think they'll help you because everything you're trying to do helps them.
Mhm.
So get some real numbers. It cost us saying,
Yeah.
move it all to cash.
Yeah.
That's right.
And
It's easy to take, it's easy to account for money that you've lost. It's hard to account for money that you didn't make, that you should have.
Yeah.
Yeah, yeah, I would agree with that. Absolutely. Okay, fantastic. Well, I will circle back with Bart when he's available and just kind of get him up to speed on today's meeting, what we discussed and then I'll keep the committee up to date on the communications that we've got going on.
Well, I hope we hear back from JP Morgan that they have looked at some of these alternatives. I've mentioned a few and I
Okay.
could do more at anybody's request. But there's just some excellent missed opportunities right within our own JP Morgan relationship.
Yeah,
I'll definitely talk to Kevin about that.
and you know, Steve, see, that comes right back as you were talking about that. Why do we need $4 million in cash or this cash? Why?
Yeah.
I mean,
I've
and if,
talked to him about, I've asked Kevin, how many times do we tap into the long term there? And we really haven't had
no,
the
never.
need to do that. So that's to your point.
So should
that
it be
is-
managed by Kevin? Maybe, but don't tell him it's
Yeah,
cash.
we
Tell him
might
it's
be
an
able to-
investment.
Yeah, we might be able to allocate it a little differently.
Yeah, or hand it to the other folks because it's an investment as opposed to cash management.
Mhm.
We've kind of pushed where he's not earning a fee. He's just our broker, right? So, and he doesn't have, although I think he's a fantastic guy. He's always been very, very good. He doesn't have a fiduciary responsibility to GBR. I mean, let's face it, he has acted like he has, but legally he doesn't. He's just a stockbroker.
Yep. If I could just add, I guess, on to everyone's comments, Dave's staff report and the conversations we had, I was mostly with Brendan, is we need to identify, in this next 6 to 30 months, what, build our own cash model.
Mhm.
Whether it's from the pools or from operating, and to try to refine and be sophisticated with that.
Yeah.
And I'm not saying we weren't doing that before, but things have changed. When I started here, the MRRB pools, that was almost 3 years ago. The pool fund had 800,000 in it.
Mhm.
Now it has over 2 million, but now we need the money, right? So things have changed, and so
But
just to
just
up our
remember,
game a little bit. And then from there, we're able to say, well, we've identified our cash needs over X period.
Mhm.
What do we have left? And, what should we do with that? Like the emergency fund, it's
It's
done great.
It's
And
doing pretty well.
and
Yeah.
if it took a hit, it wouldn't really, to your point, it wouldn't bother anybody if the emergency fund took a big hit. Cause it's like, well, it's my easiest reconciliation of every account.
right.
Because no money,
absolutely.
there's no money going in or out of it,
I know.
other than gains.
We have had in years past multiple discussions about what is the purpose of the emergency fund.
Yeah. I've asked that, being the new guy, I've asked that too.
Mhm.
It's what constitutes an emergency.
Yeah, that's right.
And maybe we need to throw definitions around that, because we do
Well, I
have.
mean, we have insurance for, all of our properties,
Mhm.
and it's not walking off anytime soon, What exactly is the risk that we need a big emergency fund for?
Yeah, I think it's probably, again, with the changes every year with the board and even committees
Mhm.
changing every year.
Yeah, that's
I
it.
think
You're
this is
right.
Probably leftover from years of people being extremely fiscally conservative and all of
We're
us have
not conservative.
backgrounds,
Yeah.
or not conservative. Yeah, but we all have our own.
Just for a laugh, we had at one point, when I got involved in this, we had 30-year notes from a municipality that yielded 1%.
Oh, my goodness.
Yeah.
Wow.
Tax free.
Yeah, it was tax, and we don't even pay taxes.
And we're a nonprofit. We don't even need tax for it.
Yeah.
I'm with you.
So I think, to me, that just makes it sound like we're moving in the right direction. We're making progress and there's always going to be room for doing better. And that's kind of, I would say my philosophy is we can always do better, and we're going to always look to refine and keep, you can't get satisfied with where you're at. I mean,
That's right.
that's what happens when you just start getting stale, and that may be what's happened. Not to point it on anybody, but that just, I think, is what happens with all our organizations is people just don't want to deal with it. So just leave it as is.
Yeah, and the CPM has a really bad history of that.
Yeah.
That's right. Oh,
But, Howie and I have another meeting here in 9 minutes, so I don't want to cut it short, but we have gone over, and I do greatly appreciate you being able to hang with us, Steve, and be on a little bit longer. And Carol, thank you for joining us as well. I guess more to come, on the next on what we are going to be doing in the next quarter. So we'll just keep marching forward. I know Howie and I are busy, and we're going to continue to stay super busy in the next couple months till we can get the budget behind us and approved, and then that gives us a little breathing room to focus on other areas like this. But this is top of mind as well. We don't want it to get buried. But
great. Well, this has been a very good meeting. Thank you very much.
yeah. Thank
Yeah,
you,
we had like
Steve.
one-on-one access to our advisors. That's the bonus of no one else showing up.
There you go.
The ratio of people to advisors was, pretty good.
Yeah, that was pretty good. Awesome. But
See, that's AI. So they said, do I need to show up for today's meeting? And the answer came back, not really.
All right. Thank you,
All right.
Steve.
Have a great day.
Take care. Bye.
Yeah, you too. Bye-bye.
All right. Yeah.
I'm sure Ryan's already over there waiting.
Yeah, I haven't got any emails on that yet.
He won't email, he'll be sitting in the lobby.
Okay.
We'll see
Well,
you later.
all right, thank
And
you,
by the way,
Carol.
Steve he's a brilliant guy. He got so disgusted with GBR, he left for a while, so I was so pleased to see him back on this committee.
Oh, good.
He, he
Good.
owned his own company, he knows investments inside now.
Yeah, I think he's gonna be a good another good steward for us. Because that's what I see the investment committee being.
Yeah, you don't want everybody on the committee to have the same opinion. It's good to have,
Different opinion.
angles
Oh,
where you're like, I never thought of that.
Yeah.
Yeah, absolutely. Okay, see you later, guys.
All right.
Good luck with the budget.
All right, thank you.
Hey, no problem. Yeah. Budget fund. Accounting.
I just want to make sure.
Yeah. all right,
He
I'll meet you over
he sent us something. Would you have time to meet at 10:30 or 11? What?
We're 11, right?
Yeah, I wanted Cliff to join us as well, and he has something that needs to be,
Yeah, Cliff is his boss. Yeah, I expected. But
well, he sent that at 9:05. So,
I'll go.
yeah, if you want to reach out to him.
I'll go kiss babies and do whatever that.
All right, cool.
Yeah.
Thank you, Howie.